Well, obviously, it's something we have to monitor. We've been monitoring it for quite a while. A lot of provocation out of North Korea and its leader, and a little bit of provocation back, I think, from the U.S. President. So we have two unique leaders here. And we'll see how it plays out, but it's not an easy one to forecast. I can tell you with my 40 years, the politics are much more important these days than I've ever seen before.
Absolutely. Steve, I wanted to bring it back over to you as we continue to follow the impact of Hurricane Harvey as well. It looks like some of those travel stocks, insurance stocks bore the brunt of most of the selling today. How would you characterize the U.S. trading day overall?
Well, I think it was fairly predictable where the storm hurt refiners much more than production. And so there's this short-term effect on refiners with a big reduction of supply, which means that for producers, they now have a falling demand. So it wasn't surprising to see prices of gasoline, for instance, the output of the refiners go up, and the price of crude oil in the U.S. go down. That was certainly not a surprise. These tend to be relatively short-lived, although there might be another knock-on effect where the gap between our crude oil prices in the U.S. are quite a bit sharper than normal compared to overseas. Instead of exporting crude oil, we'll be importing crude oil from overseas. So it might have a knock-on effect even outside the U.S. markets.
So it's quite common, of course, to have these kinds of actions with respect to short-term supply situations. Probably the price of gasoline will go up because you'll have less refining capacity also. So not fun for the consumers, but crude oil down, so some refiners are going to do well.
Well, everyone certainly hopes so in the business community. There was a great hope after the election that there would be a big focus on tax reform, and the markets anticipated that. And you saw the U.S. smaller domestic companies benefit highly. They would benefit the most from tax reform. And then when the hope phase turned to the reality phase, and a lot of activity got stalled in Congress, and there hasn't been a lot of progress made, there are increasing fears that tax reform, even though there's a bipartisan feeling that we should have some kind of tax reform, there's less confidence that it might happen before the end of the year. I do think that Congress needs to have, independent of the administration, a big win before the end of the year, before we get too close to midterm elections and so on. So I think we will see a concerted push in the next few weeks. But I don't think it's a 100% chance we'll get it.
Steve, I was wondering, thinking a little bit longer term, there's been a lot of talk about the froth in the market, a little overvalued, perhaps some from this tax reform expected but may not happen, along with deregulation, again, which may not happen. What's your view on the kind of level of stocks right now and going forward with respect to potential overvaluation or undervaluation in the U.S.?
Based on our own analysis, what we've seen is that there were many reasons for the U.S. stock market to outperform the rest of the world and to gain these valuations. There was accelerating earnings growth, narrowing credit spreads, a yield curve that was sufficiently positive, and positive investor momentum and behavior. However, we got to the point now where added gains in the U.S. stock market are going to rely more and more on investor behavior and momentum, people fearing that they're getting left out. In the last 6 weeks, we've entered a trading range, and I do believe that whichever way we break out of that trading range might be the next move. If we break out to the high side, some of the cash sitting on the sidelines might chase the market one more time, but even make it more overvalued. On the other hand, while the U.S. stock market has greatly outperformed the other stock markets around the world since March of 2009, we see more compelling values in the emerging markets.